Okay, this is a walkthrough of the test to review problems. So our first problem is going to go back to chapter 4, where there's intercompany inventory transfers. So we have the parent purchased the subsidiary on January 1st of 2013 with an excess cost over book value as follows. So we've got equipment, customer list, patent, goodwill, and their total. And then they tell us that they regularly sell merchandise to the sub. And we're focused on 2016. We do have to look back at 2015, though, to figure out what the beginning inventory is. So for 2015, it tells us there's $15,000 of deferred profit in the ending inventory. So that will turn into our beginning inventory adjustment in 2016. Then in 2016, there's intercompany sales of $85,000. There's $31,500 in the ending inventory adjustment. And then there is a year-end receivable payable of $32,500. They give us the financial statements of the parent and the sub. Okay, then the first thing it asks for is to compute the amount of equity income. So now I'm going to flip over here. So here we have it. Let me see if I can make it bigger. Okay, so we have the equity income. We start with the sub's net income, which would be pulled right off of the income statement, the $241,264. Then we look back at our acquisition accounting premium adjustments. So we had equipment at $200,000 with a useful life of 20 years. So that'd be $10,000 of depreciation. Amortization on our customer list at $105,000 over 10 years. So that would be $10,500. Then we have amortization on our patent, had a value of $75,000 over 10 years. So that's $7,500. Then we add the gross profit that was deferred from last year. So that was that 2015 had $15,000 of gross profit in their ending inventory. So now we get to recognize that because it had been sold out during the year, and we will now record it and increase our income. But then we need to defer the 2016 gross profit. So again, go back to the problem. It tells us that there was $31,500 in gross profit in their ending inventory. So that we have to defer or subtract. So then when we subtotal those, we get $196,764. So then we take that and we double check it. So we go to our parents' income statement and we say, okay, yes, that's the amount that they show as equity income. So we're all set. Then B says, okay, now reconcile the amount of the equity investment. So looking at the parent's balance sheet, the equity investment is $1,903,722. So then we map it out. So we say, okay, our E entry, we go to our common stock, which is $224,840, again, right off of the balance sheet. Paid in capital, $243,440, again, right off of the balance sheet. Then our beginning of the year retained earnings, back up in our statement of retained earnings, that beginning balance is $890,020. So then when we subtotal those, we have the net book value of $1,358,300. Then we go through our A entries. Now we got to focus on our dates. So they purchased the sub in 2013. We are looking at the end of 2016. So we want to have it at our beginning of the year balance. So we would have amortized 13, 14, and 15. So that would be 3 years. So then that's what I've mapped out here. So we take the equipment of the 200,000 minus 3 years of depreciation. So again, the 10,000 times 3, that gives us 170,000. Same thing with the customer list, starts at 105,000. 10,500 times 3 gives us that 31,500 for a net of 73,500. The patent starts at 75,000. 3 years of $7,500 amortization leaves us 52,500. And then the $100,000 of goodwill just carries forward. So we subtotal those, and that's at $396,000. Then we move to our equity income. So our equity income, again, we mapped it out over here, the $196,764. We also tied that out to the income statement. Subtract our dividends, which are found in our statement of retained earnings, $32,342. That leaves the net of $164,422. So then we'll always take these three. That's our regular entry. But now when we have these inventory sales, we also have to subtract out the beginning inventory adjustment. So that's that $15,000 that was deferred in 2015 and carried over into 2016. And again, that's a subtraction, that we subtract that out. But when we do it, we see that, okay, our equity income, or I'm sorry, our equity investment ties out to what's on the balance sheet. So then our third thing is, okay, now prepare our journal entries. So again, the journal entries are probably the most complex here because you not only have your E entry where we're eliminating the equity with that credit going to the equity investment, our A entry where we're setting up the beginning of the year acquisition accounting premium assets and then crediting equity investment. We have our C entry where we're eliminating our equity income, our dividends paid, and the offset of that goes to the equity investment. We record our current year of depreciation and amortization and reduce the assets accordingly. So again, these four entries are the same as what we always do. So hopefully that makes sense. Here's my little double checks down here again that you know, your net income, your consolidating net income rolls into your statement of retained earnings, your ending retained earning rolls into the balance sheet, you zero out your equity investment, and your assets and your liabilities tie out. But then this fourth slide then shows you the I entries. Let me see if I take it down a little bit. Okay, so then I always start with this first one. So when we go back to the problem, it told us that we had $85,000 of intercompany sales in 2016. So we have to reverse those completely. So we debit the sales to take it off the books, credit the cost of goods sold for the full $85,000. Then our beginning inventory we have to deal with. Again, it's hung up in the equity investment, just like we determined when we reconciled out the equity investment. So we debit that for $15,000 and we credit cost of goods sold. And then if you think about that, those items were sold during the year. So cost of goods sold would have been charged and cost of goods sold would have been overstated by this gross profit. So that's why we credit cost of goods sold. Then for our ending inventory has $31,500 of deferred profit. So we know our inventory is overstated. So we have to credit inventory to bring it back down to cost. And then the debit goes to cost of goods sold because in effect, it's adjusting this large credit that we took up here. Because here we're saying we're getting rid of the entire intercompany sale. Here we say, okay, well, not all of it was sold. Some of it's hung up in ending inventory. So that's why that debit goes to cost of goods sold. And then we eliminate our accounts receivable to our accounts payable. And then I think in this case, I'm noting it's in cash because there isn't a separate line item for cash. And sometimes in this textbook, it's cash / receivables. And I just left off the / receivables on my sheet. So put that in there. Okay. Then we move on. So that completes the problem. Now, again, you'll have to put it into your spreadsheet, but you know, that's just kind of hunting and pecking and putting those lines in. So hopefully you can do that without a review of that one. Okay, then let me come over here. So then our second problem is also from chapter 4, and it has to do with selling an asset. So the parent acquired the subsidiary on January 1st, 2013 at a price of $400,000 in excess of book value. That of that excess, there's $150,000 going to a patent with a 10-year life, and then the remainder is going to property, plant, and equipment. So that would be $250,000 over a 10-year life also. Then in 2014, the subsidiary sold the parent land that had a book value of $90,000 for a price of $100,000. So land we know does not depreciate, so we can kind of eyeball that quickly to say, okay, if it was on their books for $90,000 and they sold it for $100,000, in 2014, they would have a $10,000 gain. And then that gain is going to be deferred because they can't actually record that till it's sold to an outside party. Okay, so then they give us the financial statements here below. So again, our income statement, statement of retained earnings, and our balance sheet. And then we'll go over and we'll work those out. So the first thing it asks for is reconcile out your equity income. So when we do that, we always start with the subs net income, which is the $47,500. Oh, and I think that this actually, the gain actually must have actually been incurred in that current year. So, because the gain is being adjusted here. So I erase what I said that it was in the year before. Okay, so we start with our $47,500. Or no, that's what we're trying to reconcile to. We start with our $97,500. That's right off of the subs income statement. We have amortization of the patent at $15,000, amortization of the property, plant, and equipment adjustment for $25,000, and then how we know we've got the gain in that year is because then we still need to subtract another 10 to get to the $47,500 that the parent is showing in their equity income. So I think that's a typo on the sheet. But if on the test, if it's the following year versus the year of the sale, then it's not going to be an adjustment here in our equity income. It's going to be hung up in the equity investment. So it depends on what year the sale happened. Okay, then we come to preparing our reconciling out our equity investment. So we do the same thing we always do with our e-entry. So our common stock is taken right off of the balance sheet at $125,000. Paid in capital, $256,800 off of the balance sheet. And then our beginning of the year retained earnings comes off of our statement of retained earnings, the $724,000. We subtotal those for the $1,105,800. Then we go to our amortization. So the acquisition happened in 2013. We are now 2015. So we've got 2 years of amortization and depreciation to factor in. So the patent started at $150,000. We're depreciating it at $15,000 a year. So that would be $30,000 for 2 years. That leaves us $120,000. The property, plant, and equipment adjustment was at $250,000. We were depreciating that at $25,000 a year. So that's where the $50,000 comes in for 2 years. And that leaves us $200,000, and then that's $320,000. And then our equity income is the $47,500 less our dividends, which are found on the statement of retained earnings of $15,000, and that's $32,500. So when we sum all those up, we get to our $1,458,300. Okay, then we move into our eliminating entries. So our C entry, again, we're taking the net book value, all of those assets, debiting those, or I'm sorry, all of those equity accounts, debiting those, crediting our equity investment, setting up these new assets at their beginning of the year value. So after the 2 years of depreciation, crediting our equity investment, eliminating our equity income, eliminating the dividends with the offset going to the equity investment, record the actual depreciation and amortization for the current year. And then here we're going to eliminate the gain. So again, the gain, if we had this on the test, again, and you were putting it into a consolidating worksheet, there would either be like miscellaneous income or gain that we would then be debiting, and then we credit the land to bring it back down to cost. If it was the year after the sale, this debit here would be the equity investment, because the equity investment is where that gain would be housed. Okay, then we move on to our next problem. So then that next problem is from chapter 5. So then chapter 5's problem, now we have to deal with the NCI. So the parent does not own the subsidiary 100%. So in this problem, the parent owns the subsidiary 60%. There's $600,000 of an acquisition accounting premium. $400,000 is to a patent, and then the remaining $200,000 goes to goodwill. This table is missing its header. This is actually at December 31st of 2013. So it's 5 years later. So that's relevant though, because we need to know that when we get to our entries. So make a note of that. It's December 31st, 2013. But we've got our income statement, our statement of retained earnings, and our balance sheet. And then we come over and they want us to reconcile our equity income and our equity investment and then prepare our journal entries. So these ones, again, this is a little bit of a different problem than I had last semester. So I set these ones up in Excel. Let's see, maybe I can make it a little bit bigger though. Okay, so we've got reconciling out our equity income is up here. So the $360,000 comes right off of the subs income statement. We amortized out the patent of $400,000 over 10 years is $40,000 a year. So then our unadjusted net income is the $330,000. Then we do our split. So we take the $338,000 times 60%, what goes to the parent, and that's our $202,800. We take the $338,000 times 40%, which goes to the NCI, and that's the $135,200. Okay, then we come down and we reconcile our equity investment. So doing the same thing, go to our common stock, our paid-in capital off of our balance sheet, and then our beginning of the year retained earnings from our statement of retained earnings. Subtotal those, so that's where this $1,800,000 is coming in, and then split it. So 60% goes to the parent, 40% goes to the NCI. So again, all I'm doing is taking that net book value, multiplying it by 60%, net book value, multiplying it by 40%. Then our A entries, we do the same thing. So our beginning of the year patent, because we have depreciated it, whoops, I said 5 years and it's actually 6 years, 2007, 8, 9, 10, 11, 12, and yeah, that's 6, right? Yes. So 6 years to 2013. So then if we take the 6 times the 40,000, that's 240,000 of amortization, subtract that from our 400,000, and that leaves us 160. Goodwill is still 200, so we have $360,000 in acquisition accounting premium assets, and those we're going to split also. So take the 360,000 times the 60%, and that gives us 216,000. Take the 360,000 times the 40%, and that gives us 144,000. Then the C entry is always the one that I think is a little bit more tricky. This is really, this part here is all that's necessary to reconcile out our equity income, or I'm sorry, our equity investment. But I like to do this as well because it helps us build our journal entry. So here we've got our equity income, which is up here, the $202,800, less the parent's share of the dividends. So the dividends are $56,700. If you multiply that by 60%, you get the $34,020. Subtotal those, and that goes to the equity investment. And then you can see up here that I've summed everything in yellow. Not that though. I've summed the E entry, the A entry, and the C entry, and I get my total that's in the equity investment. Then I did break it out though, just to help the journal entry. So our net income attributable to the NCI is this $135,200. So that's where that comes from. Then go back to the dividends, $56,700 times 40% gives you the $22,680. And then that leaves us $112,520. Then if I sum those three entries up, the E, the A, and the C, I get what's going to end up in the NCI, $976,520. Then the next slide, I've actually done the journal entries. So then now again, picking those pretty much right up off of what was mapped out above, we create our E entry. And again, instead of having one credit to the equity investment, it's broken out 60% to the equity investment, 40% to the NCI. Set up our acquisition accounting premium assets. And instead of it all going to the equity investment, only 60% goes to the equity investment, 40% goes to the NCI. Again, the C entry is a little bit harder. It's like the combination of those two. So we have our equity income that we need to eliminate. We need to set up the NCI's share of their net income. We need to eliminate all of the dividends and then those nets. So that, again, that's why I did them separately when we're reconciling out the equity investment. So this was the amount that we calculated up above, and then that was the amount to the NCI. So I think if you map them out that way, it makes this C entry a little easier to build. Then our D entry is always the same. So we're going to, the same as every other chapter. So we're debiting our operating expenses for the amortization of the patent, and then we're crediting the patent for $40,000. And then again, if you're building that into a consolidating spreadsheet, you would put those entries right into the spreadsheet itself. Okay, then our final problem is on bonds. So let me come over here and look at that one. And you're not going to have to do the whole consolidating worksheet on that. You're just going to have to do journal entries. So we have a parent owns 80% of the sub, and the parent uses the full equity method to account for its investment. On January 1st, 2013, the subsidiary company issued to an unaffiliated company $2 million of 10-year 8% bonds with a $156,000 premium. The bonds pay interest annually on December 31st, and on January 1st of 2016, the parent acquired 40% of those bonds for $697,000. So again, they didn't get them all, they just got 40%. So then we're going to go back over here and we're going to map out the entries. So the first thing that I have you do is say, okay, what were the entries for the sub, and then what were the entries for the parent? So the sub issues the bonds on January 1st, 2013. They receive the cash for the amount of the bonds plus the premium, so the $2,156,000. They set up a liability for $2 million in bonds payable, and then they set up the premium of $156,000. Then when they get to their year-end interest accrual entry, well, I guess in this case they're paying the interest. When they get to their year-end interest payment entry, they're going to credit cash for $2 million times the 8% stated rate to get the $160,000. They're going to amortize out that premium. So the premium's $156,000 amortized out over 10 years. That's $15,600. And then the net goes to interest expense. So I always back into that interest expense what you need to make this entry balance. Then we come over to the parent's entry. So they bought 40% of them 3 years later. So they didn't buy all of them. That makes it a little bit more complex. So again, if we kind of map it out though, 40% of those bonds would have been $800,000, plus there'd have been a piece of this premium left. They only paid $697,000 for them to retire them, so they got a good deal on those. So they're going to set up the bond investment for $697,000, credit cash, their year-end entry, again at the 40%, there it would be the $800,000 times 40% times 8%, which then gives you $64,000. Then they're going to amortize their discount. So again, they paid $103,000 less than the book value. So that $103,000 needs to be amortized over the remaining life of those bonds. So that's $14,715. And again, we're debiting it because we want to slowly bring this up each year to get it up to the $800,000. So that's why it has to be debited. And then our net credit goes to the interest income. So we add those together, and that's the amount of the interest income. Okay, then we look at it to say, then the next question asks, calculate if they had a gain or a loss on that. So we look at it to say, okay, bonds payable were $2 million. The premium has been amortized over 3 years, so there's $109,200 left, which is unamortized. So that our net book value in total would have been $2,109,200. Only 40% was bought, so we'll take 40% of that. So the net book value that the parent actually eliminated is $843,680. The parent paid $697,000 to eliminate that amount of debt. So they have a $146,680 gain on that debt. Okay, then the final thing it asks for is build your entries. So again, like I said, when I did the walkthrough for this chapter, I like to do them separately. You can do one big entry, but I like to kind of break it out. So I go back and look at it to say, okay, the parents have, I'm gonna stay here. So the parents have, we want to focus on this. This is what we're getting rid of over here. So we're not getting rid of the whole bond. We're just getting rid of the 40% of it. So on the parents' books, they have 40% of their bond would be $800,000. 40% of the unamortized premium would be the $43,600. But again, it's this amount broken out between the bonds payable and the premium. Then the parent paid $697,000 to eliminate those, and they have a bond investment at that amount, and we need to take that off of the books. So then our difference is the gain. And as long as we're in the year of the transaction, we would credit that gain. If it were a year later, it would be the equity investment where that would be hung up. But in the year of the sale or the year of the purchase, it is the gain. Okay, then we eliminate our interest income to our interest expense. So I always start this by doing those two, because I know those are going to have to be eliminated. So again, if I flip back over here, I'm going to eliminate this entire interest income. So the $78,714 is where this comes from. Then if I flip back again, I can't eliminate all of the interest expense because some of it still exists with outsiders. I can only eliminate the 40%. So then if I come over here, that's what this $57,760 is the 40%. Then I'm just eliminating the amortizations between those two. So if we look over here, this $14,714 to the bond investment, I'm just crediting that to eliminate it. Go back again. The parents, I can't eliminate the entire premium because again, it's only 40% that I get to eliminate. So I take the $15,600 times 40% and I eliminate that. And then those are my two entries. So then that is what you'll have to do on your test is the parents' entries, the sub entries, calculate the gain or loss, and then the consolidating entries.